In our daily lives, banks play a crucial role, but there's a hidden truth that most people aren't aware of. Nearly 100 years ago, the visionary Henry Ford shared a remarkable insight. He believed that most Americans remained unaware about how the banking system actually worked. Ford saw this cluelessness as a safeguard against a potential revolution erupting overnight. Surprisingly, his words still resonate today, standing the test of time. Let's be clear, I'm not here to criticize the idea of banking itself. In fact, banks provide us with essential services that keep our hard-earned money safe and accessible. We all prefer to trust our fortunes with them, rather than hiding cash under a mattress or burying it in our backyards. However, behind the scenes, while the financial system operates, banks are earning significant profits, often taking advantage of unsuspecting individuals. Working within complicated and unclear systems, they hide certain actions from the careful attention of the public. Whether you're borrowing, spending, or saving, the truth remains the same. Banks find numerous ways to make money from your involvement, quietly taking advantage of you. This hidden secrecy and the complex nature of their activities have made bank stocks a source of joy for investors. Behind closed doors, multiple income streams flow, boosting their profitability, while the average person remains unaware of their tactics. In this video, we are going to discuss 5 truths about money the banks don't want you to know. Number 1. The money you keep in the bank is not tangible. While you may have a substantial amount of money in the bank, it exists as mere figures and electronic records. This is because banks utilize your money for their business operations, such as providing loans for businesses, cars, or mortgages. Although you perceive your money to be with the bank, in reality, it is distributed elsewhere, generating additional profits for the bank. This reality became apparent during the 2008 financial crisis. In a state of panic, people rushed to the banks to withdraw their money, only to discover that the banks were unable to accommodate everyone's requests. Although the banks may possess the required liquidity, during a crisis where everyone demands their money simultaneously, the physical cash reserves are insufficient. This circumstance arises due to a policy known as fractional reserve banking, which allows banks to lend out a portion of your deposited money to individuals in need of loans or mortgages. Does this imply that keeping your money in banks is unsafe? Not at all. Your money is safeguarded by insurance, and the government is prepared to intervene in case of any contingencies. Therefore, if you have money in the bank, you can rest assured and sleep peacefully. However, it's important to understand that having money in the bank is not like putting it in a box that you can access whenever you want. Your money is actively employed to generate profits, but not for your personal benefit. It serves to increase the bank's earnings. As an individual, you maintain the ability to access your money whenever you desire. However, in the event that everyone simultaneously demands their funds, the bank cannot accommodate all requests. Number 2. Your funds are gradually decreasing annually. Maybe you've heard the idea that the bank is the best place to keep your money safe. However, what often goes unmentioned is the fact that by keeping your funds in the bank, you're actually experiencing a loss each passing year. Now, this isn't related to the fees you incur during transactions or the risk of theft. Instead, it pertains to the concept of inflation. Inflation refers to the gradual increase in the prices of goods and services over time. Essentially, it means that an item you can purchase today with a $100 bill will cost slightly more in a year and significantly more in a decade. If you believe that the money resting in your account is secure, you'd naturally anticipate its value to remain steady or even grow due to interest. Every investor aims to stay ahead of inflation, but unfortunately, most bank accounts don't fully accomplish this. On average, the inflation rate in the United States hovers around 2%. When your bank account yields a mere 0.05%, it signifies that you're losing up to 1.95% of the value of your money annually. It's important to note that this doesn't pertain to funds you've invested in financial platforms to generate returns. Instead, it refers specifically to the money idling in your savings or checking account. Number 3. Bankers are not your friends. I'm sure you used to believe they were your friends. They knew your name, engaged in friendly conversations, showed affection, and celebrated your special moments. But it was all part of a rehearsed act, waiting for the right opportunity to take advantage. They follow the same patterns I mentioned earlier to gain trust. They make customers feel like they're on their side, not the bank's. Then they convince them to take loans they never planned for. Can you imagine unexpectedly getting a $50,000 line of credit? That's what happens in these banker friendships. All they care about are the numbers. Bankers have targets set by their managers and supervisors. If they don't meet these targets quickly, they risk losing their jobs. There are bankers who lost their jobs because they tried to be genuine, caring about their clients, and showing honest compassion. They couldn't meet their targets, and once the management found out, they were let go. So, be cautious when a banker friend approaches you with a beaming smile, discussing their company's latest offers. Before committing to any loan, ensure it's something you genuinely need and want. Don't allow yourself to be emotionally manipulated by fake friendships. Number 4. Banks make money from your card transactions. Every time you use your credit card or debit card for purchases, banks profit through processing fees. You may not be aware of this, because you only see the debited amount for your actual purchase, but it is the merchant who pays these fees. Alternatively, the merchant may have included these fees in the sales price to ensure their profit doesn't fall short. Let's consider a scenario. Imagine you made a purchase of an item worth $500 and paid with your card. If the merchant is charged 3% on every payment made with a card, it means a significant $15 goes straight to the bank. The bank receives this money merely for providing the payment infrastructure and convenience. Would the merchant be pleased to have $15 deducted from their profit? It is actually you who bears this fee, and I will explain how. Let's assume the item was originally priced at $480. The business owner likely raised the price to $500, including an additional $20 to cover the 3% deduction that goes to the bank for card transactions. This takes into account the fact that most people prefer to pay with their cards. Furthermore, banks generate substantial profits through credit card usage. This is why they offer enticing incentives to persuade you to sign up for a credit card. However, what you may not know is that the interest rates on your card can be increased at any time. The average interest rate on a credit card is 17%, but your bank can decide to raise it to 18 or 19%. They are required to provide you with a notice of 15 to 30 days before implementing the increase, although often these letters containing lengthy legal jargon go unnoticed or ignored. The banks take advantage of your lack of awareness, benefiting from your ignorance, while accumulating substantial profits. If you have compound credit card interests, they will continue to accumulate, ultimately working against you if you fail to pay off these debts. This can lead to financial difficulties. I am not suggesting that credit cards are inherently bad. They offer a convenient service that has become a part of our daily lives for many of us. However, caution must be exercised to avoid accumulating debts that can place you in a precarious financial position. It is crucial to pay off your debts in full every single month. And number 5. Your actions are being monitored. Banks actually keep track of all your financial activities. It's part of their responsibility, and they are legally required to report any suspicious financial activity to the IRS. This policy was implemented to keep an eye on potentially shady deals like money laundering. If you happen to make a withdrawal from your account that exceeds $10,000, the bank will report it to the IRS. In the event that the IRS needs to audit your account, they will send you inquiries and ask for an explanation regarding such transactions. Their main concerns will typically be whether you have paid taxes on the funds and whether the transactions were conducted legally. It's important to be aware that your financial activities are being monitored. Knowing this can actually be helpful because it encourages you to maintain transparency and ensure that you stay on the right side of the law. By paying taxes on your funds and making sure your transactions are legal, you can avoid any unnecessary trouble. So, it's always a good idea to stay informed and make responsible decisions when it comes to your money. That concludes today's video. I hope it was informative and beneficial to you. If you found it helpful, please give it a thumbs up. I welcome your feedback, so feel free to share your thoughts in the comments section below. Lastly, remember to subscribe and turn on notifications so that you don't miss any future videos. Thank you for watching, and I'll see you in the next one.